Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. There are many signals that the MACD can produce, and as traders, we're always looking for insight into what may come next. So whenever you're using the MACD from a trader's perspective, there's many different signals you can find from it. One of the first ones, of course, will be the crossover of the MACD line across its signal line, this black line crossing the red line. If you've watched the first video series in this two-part video series, you already know all this. If you haven't, I recommend you watch the first before going into this video any further. From this video, it's just going to build on what we've already explained. So what you can do with it, the first and most common signal, of course, would be a cross of the MACD across its signal line. It can basically warn you ahead of time when you've made a major move to the upside, made a lot of money here, you see it cross. It can give you a heads up that you may be fixing to turn back the other way as your moving averages are fixing to turn as well. This won't always be the case, and in fact, with this signal, even though you get more signals from this than anything else, a lot of times they will be false signals. You'll get whiplash in one direction or the other. For example, you have a situation here where you had a cross and then turns right around a few periods later and crosses back the other way. That's that whiplash that we're talking about. So you can have to watch out for those, and by analyzing your overall price activity, you can avoid a lot of it. Basically find situations where you have a lot of volatility, and then your signals will be stronger, as opposed to low volatility. You're simply moving sideways, you're going to get a lot more false signals in there. So that's something to think about. Another signal you can get from the MACD is whether or not a trend is true. If you have a situation where you have a series of higher lows and you're wondering, is this an uptrend or is it fake, you can simply look at your MACD low point, corresponding low points, and analyze it and determine whether or not it is confirming your trend. And in this case, it actually is, and that would be a situation that the MACD can help you in, simply finding opportunities where the chart is confirmed by the MACD itself. Another type of signal you can find with the MACD would be a divergence, bullish or bearish. Let's start with the bearish divergence. A bearish divergence occurs when price activity makes higher highs, yet your MACD does not. So in this situation here, you've had a nice advance going on, pull back, advance, all right, up here, pull back, another one, pull back, lower, and another one. All right, you got three equal highs basically, corresponding high points on the MACD here, roughly here, and here. Note that they are trending down, while the corresponding high points in price were flat or slightly elevated. This is a bearish divergence, and in this situation, you would be expecting this to fail. Price activity will fail and move back to the downside, and basically confirm the MACD. There are many cases and situations where the bullish divergence or the bearish divergence will fail, and they're the most common found in super strong, prolonged period of time uptrends or downtrends. So keep that in mind as well. They won't always be effective, but in normal situations they will. And I will show you an easy way to confirm your analysis. If you think you're seeing a bullish or a bearish divergence, I'll show you how to do that. But first, let me show you what a bullish divergence looks like. A bullish divergence is the opposite of a bearish divergence. So you're looking for situations where you have, for example, here we have a low point and then a lower low here. It's trending down at the corresponding lows of the MACD here and here. We draw a trend line across those, and we can see that we are actually slightly moving higher while price is overshot to the downside. This could be a good opportunity to go long, see the move to the upside. The question, of course, is going to come up: when do you start buying? When do you think that the bottom of this bullish divergence has been reached and price will revert the other way? And that's really difficult to do, and I don't recommend you try to catch a falling knife. So what you would do is simply note the high points and start drawing yourself a resistance line off the high points every time you make a new high, or keep going lower, even though they're trending lower highs, then they're still in the downtrend. So continue to draw out those trend lines until you see price reverse the other way. When you see a series of higher highs and a series of higher lows and higher highs, sorry about that, then you know that the trend is likely to reverse and you can start buying at that point. Otherwise, you may be getting in way too early thinking this is going to reverse, this is going to reverse, this is going to reverse, and be there a long time. Looking at our previous bearish divergence where we had 3 high points that were not confirmed by the 3 highs on the MACD, we can do the same thing. Just because you see something set up doesn't mean the timing is right. So wait for the timing to set up. And basically that means find a situation where price is beginning to reverse. Here you can look, you see the advance here, pull back, makes a low, makes a new high, so you draw your trend line out there. Keeps advancing, makes it, every time you pull back and you make a new high, draw yourself a little trend line out there and keep following price up. Sooner or later, price is going to get taken out. When price gets taken out, you make a new low, that's when it's time to start the shorting. Price activity is beginning to follow what you already saw developing here. By following that strict set of rules where you're waiting for a reversal in price to confirm what you're seeing on the indicators, you'll keep yourself out of situations that are a lot of fake divergences where you have a really strong bullish uptrend and you'll be looking like you're seeing a bearish divergence. Just if price refuses to break down to new lows, then you are not ready to see that the rewards of spotting that divergence. In fact, that divergence may not exist. So it's important to always wait for price. Finally, the last thing you can do with the MACD is look at the histogram for divergences as well. This we'll get to more information on this in a moment because it's often misunderstood. The situation here, we're looking at the histogram. You've got a high point here, right? All right, and a lower high here. So this is trending down. The corresponding high points of price are here, and let's see here. It is obviously trending up. So the argument could be made that you have a bearish divergence there, and you do. You have a bearish divergence between price activity and the histogram. However, there's a order of operations with the MACD. So you have the histogram will signal before you get a signal on your MACD line and its signal line, and then you'll have, of course, the actual breakdown of price. So those 3 things are going to be separate, and you need to think about that whenever you're seeing a divergence here. Just because you see a divergence on the histogram doesn't necessarily mean it's timely. And so what I would do is recommend waiting until both the histogram and the MACD and the signal line are confirming that. So in this situation here, you could see that this is setting up, telling you that this move here is starting to lose something, and so you simply keep waiting. Then all of a sudden you see the development here of that same bearish divergence forming now here. Okay, now you're getting the confirmation that you were looking for there. Okay, and of course you'd still be waiting for price activity to tell you the exact moment to get involved. And at this point, it might have started back here. I can't really zoom in there and see, but it definitely started here for sure if it didn't back there. So in any event, those are the different methods that I would use, remembering always that your histogram, if it signals and yet it's not being shown on your moving average convergence divergence line, simply wait for it to develop. Don't rush into it. One last example, if you can spot this, we have a high point here on the histogram, and a little bitty bump right there on the histogram. It's obviously a downtrend. The corresponding highs on the MACD were confirming that. High point here, lower high here. Corresponding price activity, however, was a high point here and almost an equal high point here. That was an opportunity to short to the downside. Finally, the last thing that the MACD can do is actually something it can't do. It cannot tell you when a stock or asset is overbought or oversold. It can actually run as high as it wants to. As long as there's momentum behind the price activity, it will keep going. So just remember that it's not a bound oscillator. It cannot signal overbought and oversold conditions. However, you can look at it as a situation of analyzing past highs, or just for a kind of a glance to see what past high brought our moving average convergence divergence line this high, and now we're at this high. Is that in line or out of line with it? That's about as best you can do with that. We don't recommend you try to use the MACD for an overbought or oversold condition indicator. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.